Hello, everyone, and welcome to the latest LPL market signals. Jeff Buchbinder here, your host for this week, with my friend and colleague, Kristian Kerr, LPL's head of macro strategy. Kristian, thank you for joining today. It is Monday, February 3rd, 2025. I guess you could say it's Trade War Day as we are recording this, although certainly a very fluid situation. And so we'll spend most of the time walking through some of the key takeaways from the tariff situation, work in a little bit of a discussion about U.S. exceptionalism, and then preview the week ahead as we always do. So, Kristian, welcome. How are you?
Hi, good to be here. I'm very good. Excited to talk about the tons of things that are going on in the markets right now.
It's a lot. I hope none of you did exhaustive studies of the Mexican tariffs this morning, because they were just delayed and may not need that study at all. Let's get into it. Again, we'll spend most of the time on tariffs. I also want to mention I was in Miami this weekend, 80 degrees. So now that I'm back home with the snow and colder weather here in Boston, I'm wearing a little bit more of a springy sport coat today to try to keep my mind back in the warm weather. So hopefully it's fairly warm where all you are. Here's our agenda. Market recap, of course, we'll be quick with that because the market really doesn't care that much about what happened last week at this point. It's all about tariffs. So here you see we'll do top 10 tariff takeaways. We could have done a top 100. None of you would listen that long, but there's just so many elements to this that you could go on all day. We've tried to boil it down into just 10 and give you some of the most important things to think about. Next, our weekly commentary on LPL.com is about American Exceptionalism, written by our chief economist, Jeffrey Roach, with some help. So we're going to make the case in that piece that American Exceptionalism is not dead. Then we'll finish off with a preview of the week ahead. Of course, it's Jobs Week. It's really more Tariff Week than Jobs Week, but we'll hit them both. So Kristian, the last week was really seemingly more about tech weakness than anything else. The S&P 500 down 1%, but if you take out tech, it was actually pretty close to flat. What do you think were the key drivers there?
Yeah, I mean, we kind of had very similar Monday to today last week, right? But it was that DeepSeek news. It kind of was the market really trying to sniff out, how relevant, how important that was. I mean, I think you did see some interesting things kind of underneath the surface in terms of value and growth, and there were some interesting rotations. But all in all, by the end of the week, it seemed the market had been able to get through that, and then late in the day on Friday, we started to get these tariff headlines, and lo and behold, we have kind of a very similar opening to the week with a little bit of turmoil caused by that. But yeah, I mean, I was thinking that maybe it would take a little bit longer on the DeepSeek kind of reaction from the markets, but it was fairly swift, and the markets handled that really well. And I think I mean we'll talk a little bit about later in the U.S. exceptionalism piece, but it seems for the most part much more about tariffs now than anything.
Yeah, and we were clearly warned that this was coming many times by Trump and his administration. So it's really not that much of a surprise, although I think some folks were hoping that they would be, watered down, walked back, exceptions, etc., sooner. So we'll see. But certainly there's a little bit of tariff trade uncertainty, I think, in last week's weakness too. Plus, with tech, you have chip export controls, big losses for NVIDIA last week, as well as Microsoft, because the market didn't like Microsoft's earnings, which is another reason why we were down so much in tech. Communication services led, certainly strong performance from Meta has been part of that. And turning to international has done generally pretty well this year, despite pretty lackluster economic growth and certainly trade risk concerns in Europe. Tariffs on Europe are probably coming pretty soon, as President Trump has indicated here over the last 24 hours. So moving along. Oh, and by the way, the economic data was kind of in line mostly, and not really a big uh, market mover last week. The Fed was, as you said last week to me, Kristian, a nothing burger. Pretty much as expected. Not a whole lot of news there. So turning the bond market or the commodities market, I mean, bonds were strong performers last week. Kristian, I mean, I know we got the Fed's preferred inflation measure, the core PCE, which was decent. What else drove the bond market or the commodity markets last week?
Yeah, I mean, I think with bonds or it's really about short-term rates right now. Again, I think we can talk about what happened last week, but really it's going to be, how does what's going on with the tariffs start to impact potential Fed thinking, other central bank thinking, with respect to the path of short-term rates. So I think that's going to be clearly what's driving things now. You can make the case that, given this is a little bit, broader reaching than people thought, that maybe the Fed has a little bit more of a reason to be putting things on hold. So I think we're going to be kind of sussing that out here over the next week. And I think that's really what market's going to be caring about in terms of that. And I would say, there's been some interesting things going on in commodities. Oil's become very correlated with these tariff headlines. What's been going on in the gold market, probably a little bit too complex to get into here, but some very interesting things is basically there was some front running of potential tariffs by certain players in the gold market, so moving physical gold from London to New York, and that's been causing a little bit of shortages in London and excess physical here. So it's been very interesting. But gold making new all-time highs last week. I think worth watching very closely. I think we don't talk about it too much, but gold in foreign currency terms, like gold in euro terms is basically up 50% over the last 12 months, right? So some interesting things going on with the precious metal space that I think continues to be worth watching. And then of course, I'll just front run you and go in that foreign exchange, but I think foreign exchange has been probably the most focused on what's going on with tariffs because arguably they're the most directly impacted because what tends to happen is if you slap a tariff on somebody, what are they going to do? They're going to readjust their exchange rate to take in that account, right? So you slap a 10% tariff, and I'm gonna move my currency down by 10% or what it is. So we've been seeing kind of the markets for the last 2 months really focused on that in the FX market, and we've seen this morning some pretty big gap ups in the U.S. dollar versus obviously. We had one against pretty big one against the Canadian dollar, against the peso, which came all the way back when that announcement came out that the tariffs would be delayed. But I think the FX markets are arguably where you see the most direct impact from these types of announcements.
Sure, that's right. And you also see, the markets start to price in just less goods flowing across the borders, and that's affecting some of the transport names too. So we'll get to more about industries and sectors in a little bit, but certainly transports are an area that's struggling a little bit today. So thanks for that, Kristian. Here's the S&P 500 chart. This factors in this morning's losses. So you see 59.30. So we've broken a little bit below the 50-day, the 20-day and the 50-day moving averages, but we've still got a fair amount of cushion before we test the 200-day 56.34. So that will be another 300 points down on the S&P 500. I've said it a number of times. We'll test the 200-day at some point, but it's just I thought it would have already happened by now. I've been talking about that for a few months, but we'll wait and see just how long these tariffs are left in place, and how much they're ratcheted higher, and how many exceptions there are. Right, those I'd say are some of the key factors that will determine just how much stock market weakness we get, and then that, of course, will determine how quickly we do bounce off of the 200-day moving average. We'll get there eventually. It's just math. but got a good bit of cushion. We're still in an uptrend. The breadth metrics aren't bad at all. There's winners and losers. Steel stocks doing well on the tariff protection, for example. This metric of 62% of stocks in the S&P above their 200-day moving average probably is going to hold up okay, which is good. It's not a great breadth reading, but it's a decent one. So 10-year yield. Here I'll bring you in, Kristian, what you think of the 10-year. I know you're going to bring in tariffs again, but if we think, if the Fed cuts twice more, which is still our base case, there's more uncertainty around that base case. But if they cut twice more and tariffs cause a little, and retaliation from our trading partners, which has already been announced in Canada and which is, planned in Mexico if needed, that slows economic growth, right? And that in turn puts downward pressure on rates. So even though you might have a little more inflation from tariffs, you're also going to have downward pressure on growth, and you'll probably have a Fed. Maybe they won't cut in the next 6 months, but you'll have a Fed eventually that's probably going to cut ahead of that growth slide. What do you think?
Yeah, I mean, I think things are kind of following the path we kind of outlined in our yearly outlook, right? Where you get to the higher levels, closer to 5%, you start seeing pressure to on yields lower, and you start getting kind of the lower levels, and you see pressures for yields to start moving back up. So I think we're seeing that play out. I think we also talked about the potential for hiccups on inflation concerns, which you get that with the tariff policy, and I agree with what you say. I think we'll probably end up, there's room to cut more, and it's just the path to get there is not going to be as linear, I think, as the markets were thinking they would be at the start of the year, and we're kind of seeing that play out. But I think the other big thing with the fixed income markets is just, it was interesting that when the headlines came out, there was kind of a move into bonds, right? So I think it goes kind of back to what Lawrence was saying in the outlook as well, that in bigger periods of risk off, you can expect bonds to still act as a potential natural hedge to equity weakness, and kind of more the little smaller moves, it doesn't do that as much. But I think that's another big factor. If we were to get, let's say things escalate a little bit more, you'd expect bonds to start kind of having that natural hedge aspect to them too, from a asset allocation perspective. So a lot of things to watch. But I think in the near term, so putting on your short-term traders cap, it's going to be very much about trying to figure out, the markets will be thinking about, all right, how aggressive is the Fed going to be able to be here with this going on. I also think kind of rates outside the United States are going to be very interesting. You have the ECB just cut, kind of been talking about a path to lower rates, which the markets have been expecting. How does this impact what they're going to do, particularly, again, going back to the foreign exchange side, if they start kind of tweaking FX rates there, does that end up shifting what they do with rates? So there's going to be a lot of kind of just question marks with what's going on around the near term path of rates. But I think ultimately, the path to get there won't be as linear as everybody thinks, but we'll probably still kind of make our way to those two cuts in the U.S. at least over the by the third or fourth quarter.
Completely agree. Probably back end loaded.
Yeah.
So thanks for that, Kristian. Let's move on. I mean, we know we're going to talk tariffs a lot here, so we already have. It's a bull market and uncertainty, certainly. So I've got 10 takeaways. I'll just read 5 at a time. I put 5 on each slide, and then Kristian, I'll have you comment on any and all of these.
Sure.
So number 1, timing and duration remain uncertain, so don't overreact. I've already been asked, should I buy the dip today? Right? And I'm sure many of you are thinking that. Well, this isn't even really a dip yet. This market, the S&P 500 is not hardly down 2% from peak. So, we don't really call anything a dip until it gets to 5%. Probably will get a 5% dip at some point fairly soon, given all this uncertainty, and given that this looks like a real shift in policy, not Trump 1.0. But we'll just have to wait and see. We certainly wouldn't overreact. You learn that with the Mexico news today, right? Things change fast. Number 2, tariffs on North American trading partners are a negotiation. right? So we already negotiated with Mexico. They're sending 10,000 troops to the border, and therefore tariffs delayed. This is the carrot and the stick. That is the same in Canada. We will get some sort of concession, most likely from them. Those tariffs will be delayed or removed completely at some point. Now, some of this is related to a long-term shift in trade deficits. So you may see some of these tariffs remain in place permanently, even with our friends in Canada and in Mexico. So that's an important caveat. Number three, tariff costs will not fully be borne by consumers, right? Kristian, you mentioned one reason why this is the case because currencies are going to adjust. Another reason why the wholesalers, the companies will absorb some of these costs. So just because there's a 25% tariff potentially on avocados from Mexico, that does not mean that the prices of avocados will go up 25%. They'll go up much less than that. They will go up, but they won't go up 25%. So keep that in mind. That's good for inflation. Inflation will go up, but not much. And it probably won't be sustained in many of these cases. Number four, I have a chart of this. The U.S. has limited revenue exposure to China, Canada, China, and Mexico. In fact, I've seen one estimate, it's only 7% of the S&P 500 revenues are from those three countries. So this is really about costs. It's kind of like the COVID supply shock, right? You just have to spend a lot more for stuff, and then in turn you see prices go up. This is not so much about the retaliation because we don't have to buy so much Mexican imported beer. We can drink the beer here, and the revenue in the S&P 500 from Mexican beer or avocados is pretty low. China, it's a bigger deal, of course. We have a little more revenue with China than we do with Mexico and I think Canada as well. So last one on this slide, and then I'll go to you, Kristian. Overall impact on economic growth and the S&P 500's profits likely to be limited. So part of this is around the fact that we don't import everything from just these trading partners. Part of this is related to the fact that we make stuff here, a lot of it, right? So we're only talking about some costs for some of the inputs to find, finished goods, or in some cases we import the finished goods. We're only talking about a portion of that, right? We're talking about, I think the number is somewhere around 900 million in imports from Mexico and Canada, just to focus on those two. So, the impact, I've seen a lot of estimates. Maybe we're talking about a 0.5% hit to GDP, maybe a little more if all this sticks. And maybe we're talking about, I think reality, 2 points of S&P 500 profits by the end of the year. Could be a little bigger than that, depending on if all of these stick. I've seen forecasts as high as 7-8% hit to S&P 500 profits. I just don't think all these tariffs are going to stick throughout the year, and that's why I think we would caution folks about being too negative on the hit to profits. So I'll stop there, Kristian, and have you weigh in on any of these that you want.
Yeah, I'll start or look at two and I guess one by extension, but really that's the crux of the matter here, whether how impactful this is going to be. Because I think there's a lot of the majority of people in the market right now think that this is really just a negotiation tactic by the Trump administration to try to achieve certain parts of their certain objectives of theirs, right? And we saw that today with Mexico, where the kind of clear thing was to deal with the border situation. Obviously, the negotiations or the phone call went well to where they were starting to get progress on that, and lo and behold, the tariffs got pushed back a month. I think with the Canadian situation, there it's about if you listen to the lawmakers, particularly within the Trump administration, people like Lutnick have said, it's really about getting the Canadians to pay more in terms of military spending. So that's a much more complex thing to iron out than sending troops to the border. So, but I think bottom line, what we're just trying to point out is that that's probably what this is, right? It's not, it's not anything more, uh, like a bigger picture deal, assuming that that is what it is, right? I think where it gets a little bit more difficult from the market standpoint is, if we start getting in a scenario where it starts becoming, okay, broad reaching, doesn't matter what country, uh, what country has tariffs. It's going to be, anyone who imports to the U.S. And that's a little bit more tricky for the markets, right? Because then that starts to change the game dynamically from an economic standpoint. So I think we're all trying to kind of suss through that right now. But it seems, I think the market thinks that right now this is really just about kind of, Trump starting from the Trump administration, starting from a certain level that, to try to get certain policy objectives, and then it's a little bit of back and forth, and then, hopefully these things kind of start to go away as the objectives are reached. So I think that's going to be important. Definitely the market's got a little carrot this morning with the Mexico news, and we'll see how things go on the Canadian side. A little trickier there because there's certain the certain politicians within Canada are kind of using this to their advantage to try to talk tough in response to the U.S. So whenever you start getting that kind of tit for tat, things can happen, right? So it's something to be on the lookout for. But I think ultimately, everyone's trying to like come to the table and figure out how to best proceed with this. So as long as that's what it is, and the market perceives that that's what it is, I think the impacts could be relatively limited. So hopefully that's the case. I think it's a little more difficult with China, and I think that's why the administration started with a lower number there, because those probably will be tariffs that are in place for a longer time, because those really are, they're bigger issues, they're bigger policy objectives that the administration is trying to deal with there. So I think they started small, and it seems from what we've seen so far, the Chinese government is already starting to come to the negotiation table and start talking about ways to move forward on this. So as far as this thing could go, if you told me that what the headlines would be a week ago, that they were going to be this, I think things aren't as bad as they could have been, now that we're here in the midst of it.
Yeah, I think the markets have held up well, in part because people thought this was, a stick that would turn into a carrot
Yeah.
for the most part. China's a little tougher, and you've seen some meaningful weakness in semi names, the Nvidias and on down the line. Clearly, part of that is related to the China AI advancements, but it's also related to export controls, national security issues, and that points to maybe a tariff, like you said, that's going to stick. So we'll have to watch that closely. So here's our next five. We already alluded to 2 Fed rate cuts still being on the table. We think that is the case. Again, as these tariffs we want that. We want the economy to slow a little bit to put less pressure on inflation, right? So this isn't a bad thing, but as the economy slows and puts less pressure on inflation, part of that slowing growth is going to be related to tariffs, presumably, especially if we get tit for tat with China. Might even get a little bit of that. We hope we don't. Might get a little bit of that from Canada and Mexico as well. That increases the chances that we get 2 Fed rate cuts this year. The market expectations are 1.7. They haven't really changed. The 2-year yield's up a little. So yes, they have the chances of 1 cut are up a smidge today, but not meaningfully. And the 10-year yield is down a tad. So bond market's taking this in stride. Number 7, tariffs and strong dollar to weigh on emerging markets. So this gets more into asset allocation. Of course, China drives the bus for emerging markets, and the risk of investing in China has just increased. They also got some weak economic data over the weekend, by the way. We already knew the Chinese economy was struggling. We're getting more evidence of that. So in terms of the EM index, we think the outlook as a result of this is weaker. Not just tariffs, also the currency strength in the US dollar. Number 8, domestic sectors are relatively more insulated, so financials could be potentially a relative winner here because they're, a lot of these regional banks certainly I mean, pretty much all sectors except utilities and real estate have a meaningful global footprint. So there aren't too many places to hide here, but financials may be a relative place to hide. And I think even, maybe healthcare is a relative place to hide. Maybe Kristian, you can add to that list here in a minute. Market cap. Point number 9, effects on small caps may be more limited. So you're more exposed to tariffs if you're importing more as a company, right? So it makes sense that a more domestic, smaller cap company would have less tariff exposure. They tend to sell less outside the US, and they tend to source more, have less complex supply chains, source more in the US. So there are a lot of factors here to consider when you're trying to assess large caps versus small caps. But when you look at just tariff and trade risk, small caps a little more insulated. And then finally, number 10, I thought this was a good one to end the list with. Trump cares about the stock market. It's kind of like people talk about the bond vigilantes. If you spend too much, if the deficit goes too much above where it is, the deficit should come down. Bond vigilantes come in, right, and they sell treasuries. Collectively, they influence the bond market. Yields go up, and that forces action for the federal government to spend less. It's the same thing here. The market throws a big temper tantrum. Certainly, President Trump does not like that. He views the market as somewhat of a report card, and that could speed up reversals. I don't know if it had anything to do with Mexico, maybe not, but certainly if he is too aggressive, there is a point, and he's said this himself, there is a point where the market is too weak and he backtracks. So over to you, Kristian, comment on any of those.
Yeah. Well, there's that old saying, right? Like markets stop panicking when policymakers start to panic, right? Which is basically when they start, hearing the market's message that that's what markets tend to like. So I think that's clearly important. I think he walked back some comments that he made, I think on Friday afternoon about not really caring about what the markets do, and kind of walked that back over the weekend. So that was all in all a net positive from a market standpoint. A few things. I mean, I think on the dollar is important, right? We touched upon this, but just FX is so directly impacted by tariffs. I think over the next few days, it's going to be really interesting to watch what happens in China, because they're basically closed for the Lunar New Year. So we're not really getting the FX reaction you would expect after this announcement, because not to get too deep in the weeds on how it works, but they they have a managed currency there. So they have the CNY, and it's done by this basket, and basically with everything closed, they aren't as active in that right now. So kind of markets are looking for kind of later in the week to get the real response. I think that's going to be important. But bigger picture from an investment asset allocation standpoint, at the index level, emerging market indexes have a very hard time, outperforming when they have a strong dollar headwind. Like the time typically that EM does really, really well is when the dollar is weakening, right? Because you have that tailwind behind you. So again, with countries, they're kind of the easiest, and the easiest tool in their tool bag when they get slapped a tariff is to just literally take down the exchange rate in response to that. And also the fact that I think, as you mentioned, Jeff, when you have higher tariffs, there's a little bit less trade out there, a little bit less supply of dollars. Less supply tends to see a currency go up. So I think all those factors are going to be really, really, really interesting here. And I think kind of net mean that EM as an outperformer is going to be like really, really tough in this environment, unless we just get radical, clear transparency on what's going on here, in terms of there's just going to be a select a few countries that are tagged with tariffs and things like that, which doesn't seem the case, at least for the moment. But kind of things to think about, I think, in the interim. And let's see what else. Yeah, I mean, I think on the rate cuts, we've talked a little bit about that. Obviously this puts a little bit of uncertainty there for the Fed, but ultimately they have room. It's just, I think it won't be probably gets back half there in terms of when the Fed feels more comfortable after they've kind of seen the impacts of these things on the economy and get more clarity. So that's ultimately a good thing too, because I think kind of how the markets were, how many cuts they were pricing in to start the year, particularly in the back half of last year, was just unrealistic. So this almost kind of pulls attention focus back to I think a little bit more realistic kind of end target for the Fed in terms of this rate cutting campaign. So better for markets to price that in now, adjust earlier for it. So, again, net could be some positives here from all this in kind of the broader scheme of things.
Yeah, good stuff. So I think autos is kind of where everybody goes first, right? There's a ton of exposure to Mexico and Canada in the auto industry. So it should certainly, point that one out. Those are some of the biggest movers today. I mentioned railroads earlier. There's certainly retail exposure for companies, apparel. You're importing a lot from China. So certainly that group is seeing some volatility here. And then I mentioned food. Certainly the food sector or food industry group within the consumer staples sector is seeing a little bit of volatility today. Oh, and then avocados out of Mexico. Certainly there are Mexican restaurants in the US that are going to see their costs go up. So you're seeing some volatility in that space, which of course is led by Chipotle. So I got a few charts here on the trade situation. I'll be really quick with these, and then we'll get to the American exceptionalism and we'll wrap. So much to talk about. So this is just an index of trade policy uncertainty. It's essentially, counting words from media reports. And you see here, we're almost back to peak trade uncertainty where we were in 2019 when, Trump 1.0 tariffs went into effect. These tariffs are bigger, actually. I think it's about 4x. If you take out, it depends what you do with Mexico. 4 to 5x is big because they're broad, right? Relative to 2019. But in 2019, we hadn't seen this before. So uncertainty was higher as we were all trying to understand. Now we kind of have a playbook. So high uncertainty, but a little less uncertainty than we had before. I thought this was interesting. This is revenue exposure by geography for the S&P 500. Thank you to Goldman for doing their math on this, so I didn't have to. Not every company reports all of their revenue by geography, but most of them do. So this is a pretty good look. And you see 72% in the US. In Latin America, which obviously includes Mexico, you've only got 1%. So hardly anything. Other North America, which obviously is Canada, 3%. We don't sell a ton of stuff in Canada. That's one of the reasons why the Trump administration is doing what they're doing. They want more balanced trade, but this is good news for the S&P 500 selling into Canada. That's not going to really have any impact at all. And then China, Asia Pacific is 8% of revenue, but that includes Japan. So there's a lot of revenue and Japan out of that chunk. So the direct China revenue, where we're selling into China, Apple's certainly a big player there. That is not a huge piece. Again, this is more about costs for US companies doing business overseas than it is about revenue. So next, inflation here. Kristian, thoughts on how inflationary tariffs are? I mean, if the world looks like you think it's going to look, how much of a boost to inflation is that, and how long would it be sustained?
Yeah, it's tough to handicap when you don't have all the details, but I think
It's fluid.
yeah, but I think now, given how limited the scope is, it's fairly minimal. I've seen, fairly the estimates I've seen out there are fairly low. It's just the knock-on effects that's the reality, right? So if you start getting, stronger dollar coming, you start seeing companies maybe even front loading, potential kind of raises to, passing on to the consumer and prices there. How do you gauge that? So, I don't want to go out there and put a number. That's Dr. Roach's job, but
And it's impossible with
yeah,
how much information we have.
yeah, precisely. I think that the key thing to note here, though, is just that, there is that that potential for hiccups, right? Because there's, it's something we haven't seen, as you've noted in years. And, I think these are the highest tariffs since, Smoot-Hawley in the 30s, right? So you're talking, a regime that no one really knows. And, as you said in the outlook, right, we expect to see hiccups this year in terms of, if trade becomes an issue, then that's going to naturally kind of force people to start thinking about potential, higher levels of inflation out there. I think in the end, it won't be as bad as people think. But that potential to see little hiccups between now and finding out the details, I think is definitely a real possibility the market's going to be dealing with. And as we said, it's going to impact the path on rates. Might not affect the end number that we do, but the path to get there will change, and that's just going to be a fact of the matter of what this brings to the table.
Yeah, the Canadian energy tariffs are being felt in markets with higher energy prices. That certainly can influence inflation expectations. So hopefully those will come off. But
I will say too, I mean, the other key thing is listen, Trump, a big reason that he was able to win was inflation, right? So, politically, he does not want to see inflation start to get too high. So, he can pull back on the reins if he feels that's starting to happen, right? Again, it's one of these things that, if you let the kind of cat out of the bag, can you control it? That remains to be seen. But I mean, in the end, I don't think he doesn't want to get labeled with that going into midterm. So I think there's that push-pull dynamic here with respect to inflation and him in the administration on how far they want to press some of these initiatives.
Yeah, good point. Here's the US dollar chart. You mentioned, Kristian, that FX is really the center of this. The dollar is right back near its recent highs, right around 109, 110. Technically speaking, if we break through this level, which decent chance we do, then you make a run at like 114, on this chart, kind of that 112 to 114 range. So this is a very bullish chart for the US dollar. It's not even overbought yet on the RSI 14. Again, influences earnings for multinationals doing business overseas. Stronger dollar means those profits translate into those foreign currency profits translate into fewer dollar profits, and then U.S. investors get less return because they have to translate their international returns into U.S. dollars. So the dollar is vitally important, and it tightens financial conditions. So when you see these forecasters, I'm sure they're all over the media today, trying to assess the economic impact and the market impact of tariffs, you always have to consider that tighter financial conditions related to the tariff news will slow the economy and potentially negatively impact capital markets. It's not just the tariffs themselves. So let's turn to American Exceptionalism, Kristian, in the weekly market commentary, which you can find on LPL.com. We make the case that American Exceptionalism is intact. So here's a few reasons why. So first, this is a measure of innovation. Part of this is R&D spending, and part of it is like tech startups and things like that. And so this, Bloomberg has put together, there's a list here on this slide for those of you who are watching of some of the things that are in here. Manufacturing value added, number of public companies as a share of the total high-tech public company universe, post-secondary education, all of these sorts of things. So you put all that together, and our innovation is continuing to rise, and we think it will continue. We have the entrepreneurial advantage, we have the R&D spending advantage, and we have a currency advantage, which, effectively keeps the US dollar as the global reserve currency. US dollar is this shows that US dollar is about half of all global transactions. Certainly the euro has a big chunk too, but we are the leader, and this isn't going away anytime soon. So that helps, essentially, just to put it simply, kind of fund our exceptionalism and our innovation. And we also have a lot of global market cap. So this just shows we're not only we're about half the global currency transactions in the US dollar, but about half of the global market cap is in the US. And certainly that has been moving higher here recently. So all of those factors we think keeps us in the lead. So Kristian, anything to add there?
No, I think it's a great point on, being the reserve currency, comes with a great privilege, right? But it's as long as that's not threatened, I think the U.S. exceptionalism story continues, right? It's just it's kind of a natural aspect of that. Like all this stuff we've been talking about with tariffs, it's because the dollar's reserve currency that it has this global impact. So I think there's a lot of talk out there always about is the reserve currency status coming to an end? We don't think that's the case whatsoever. And clearly, kind of a lot of the charts you show that is the case. But I think that's one of the underpinnings to the exceptionalism story. And then you add in things like what's going on in AI and kind of the leadership the U.S. has in tech, and it just seems like a very, very powerful, unstoppable trend for the intermediate term.
Yeah, agree 100%. So, and markets are reflecting that with continued strong performance from the AI complex. China's DeepSeek found a clever shortcut, and probably accelerates global innovation in terms of use of power and how many data centers we have to build and things like that. We'll see, but we're still going to be the leaders there. So thanks for that, Kristian. Let's go to the week ahead real fast. It's just going to be a lot of tariff talk, probably more than anything else. But we do have the jobs report, consensus 170. That this is going to include some effects of the tragic California wildfires. So I don't know how that should probably take job ads down a bit. That's really my only thought there. Anything to add either to that, Kristian, or any other data that you think is meaningful to watch this week?
Yeah, I just think with what's going on, it's one of those rare events where payrolls and unemployment won't be as impactful as it would have been had this not happened this week. That's the real takeaway. It's that usually that is kind of one of the big days of the month. Still being important. Obviously it's a very big barometer, key metric for the Fed, but I just think given what's going on with the T word this week. It's just not going to have the market impact that it normally would, and that's probably the key thing to highlight there.
Yeah, the ISM data this morning was actually quite strong. So yeah, I think we've got a little bit of a cushion. When you raise rates a bunch, you can then cut them. When you have a stable and strong economy on solid footing, if it slows a little bit, that's fine. And I think that's probably all we need to say there. It's a big earnings week too, and so it'll be interesting to hear what companies have to say about tariffs. You're going to get a lot of vague, the situation's fluid kind of commentary.
Yeah.
But from some companies that are more directly hit, you'll probably get a little more than that. So I think it's 131 S&P 500 companies that report this week. That is a big, big, big number, including Amazon and Alphabet/Google from the Mag 7. So certainly we'll be watching those as well. But really, it's all about tariffs. So we'll stop there. Went a little long today, but there's just so much to talk about. We think it made sense. So thanks, Kristian, for joining this week. Thanks to all of you for listening to another LPL Market Signals. We'll be back with you next week. See you then.
See you later.